It is a red Monday morning. Well, earnings season is almost phasing out, so it's perhaps a good time to start taking stock and look at how sectors have performed. Today, we put the spotlight on the IT space. That's the one area where we've seen plenty of cheer and some smiles in an otherwise bleak season. Reema is here with the fine print. Reema?
Well, on the whole, the December 2018 quarter was a strong one for the IT sector, and this is despite the seasonal weakness in furloughs which typically happen in the December quarter. It was aided by solid IT spending environment and strong deal wins. In fact, HCL Technology saw a 5.6% sequential growth, followed by Infosys at 4.3% quarter-on-quarter. In fact, if you look at it on a year-on-year basis now, TCS, Infosys, as well as HCL Technology are tracking double-digit growth rate, and this is a broad-based growth that we've seen. On to the mid-cap performance, it continues to track above the large-cap growth rates. The revenue growth this quarter was the strongest for L&T Technology, L&T Infotech, and Zensar, while for mid-cap companies like Cyient and KPIT Technology, we saw the revenue growth moderate. On the margin front, however, that was a disappointment. There was a decline in margins seen for companies like TCS, Wipro, HCL Tech, while Tech Mahindra and Wipro managed to improve their margins sequentially. The H1B situation seems to have gotten a bit tougher, and the tight labor market is spurring cost pressures, putting the margins under pressure. In fact, this is a big risk to watch going ahead as well. The deal pipeline, moving on, continues to look extremely robust. TCS positively surprised on the deal wins. There was a 20% increase on a quarter-on-quarter basis to $5.9 billion in this quarter, in a seasonally weak quarter, that too. HCL Tech had record bookings, while for Tech Mahindra, it was the telecom vertical which continues to improve on a sequential basis in terms of deal wins. To give you a sense of 2018, Infosys has reported an 89% jump in deal wins in calendar year 2018. Hiring remains quite strong in light of the supply shortage, so companies continue to hire quite aggressively as they anticipate improved demand environment. Net hiring for 6 large companies, that is TCS, Infosys, HCL, Wipro, Tech Mahindra, as well as Cognizant, stood at close to 31,000 employees, which compares with less than 6,000 employees in the same period of last year. Digital, that continues to be the big growth driver, and we've seen strong growth rates of 30 to 40% on a year-on-year basis. The revenue contribution roughly stands at 30 to 35%, which would compare with 25% a year ago. But as we look ahead to the next financial year, the sector faces some global headwinds. US may not post the kind of growth that it did last year with the lack of that one-shot gain from the tax cuts. There are fears of global slowdown given the trade tensions. The softening trajectory of US yield curve could impact the financial services. Brexit and visa pressures could further pose challenges on the demand fulfillment side. While companies so far have not spelled out any macro concerns, they are in a wait-and-watch mode while focusing on digital transformation. So the question is, with this backdrop, can IT companies deliver better growth next year in FY20, as is largely priced in by the market? Though off late, you are hearing a few voices of dissent. Brokerages like JP Morgan, Morgan Stanley, Nirmal Bang are turning a bit cautious after the recent outperformance and the global headwinds. Talking about outperformance, the IT sector has seen a 25% outperformance vis-a-vis the Nifty since the start of 2018. But many stocks are now trading at peak cycle multiples, and they've baked in elevated revenue growth as well and sustenance of profitability. TCS still continues to trade at a premium, but after the Q3 numbers, the valuation gap between TCS and Infi has narrowed to 15%. The other noteworthy change which has taken place in the valuation is now that Tech Mahindra is trading at a premium to HCL Technology, given the strength of its communication vertical. Net-net, it's been a good quarter for the IT companies, given a good demand environment and solid order booking. But margins continue to remain under pressure. Back to you.
Okay, I want to take that point forward, Reema. Thanks so much for giving us all those details. Sandeep Agarwal of Edelweiss is joining us. Sandeep, hi, good morning. So as Reema was telling us, decline in margins is what we've seen for most companies, TCS, Wipro, HCL Tech, and there could be some more cost pressures in the quarters to come. How are you reading into all of this, and what could the big takeaway be? More margin pressures for many of these companies?
So see, I think, we need to understand the sector in a little different way. I would like to recall that, in last year in March, we have come out with a series called Most Bullish in a Decade, and we came out back-to-back 5-7 notes on that, and we were clearly calling out that this is the sector which will do extremely well, and because of the structural improvement in demand growth rate should double, and that is what exactly has played out. I would like to again highlight that, you know, what street is being cautious right now, and obviously one piece of that is the US macros, which, you know, obviously impacts us on the BFSI vertical in a big way. But I would like to also highlight at the same time that the thesis of most bullish remains our thesis, and it is based on a strong view on the digital ecosystem. So I would like to highlight that, you know, if you see the client spends for digital for most of the top 5 IT companies, they are very small still, although the proportion is 30% and it is growing at 35-40%, but the amount which each company or each enterprise is spending is very small. So it is being spent by a large number of clients. So I think that is a very big key takeaway from the results. And we can have two kind of problem in the supply side. One, when, you know, on the margin side, one when, you know, our margins are going down because of lower growth, and another would be our margins going down because of higher growth. We are on the second scenario, and I think it is a very exciting scenario to be in, because, you know, it simply says you one thing, that right now the demand is much higher than what has been forecasted and planned for. And to fulfill that, people are hiring subcontractors. And obviously, you know, as Rima already gave the number, 30,000 people have been hired in last quarter. And if you see the previous 2 quarters, then total number for top 5-6 company would be around 90,000. So these people are obviously under training, and they will get deployed in coming months. And when that happens, then this margin pressures will wane off. Secondly, if you see, digital is now at 25 to 30% for most of the companies. Generally at 35-40% proportion, the margin leverage plays out in a big way. And also we should not forget that digital is will be a high margin business because of the billing rates once, you know, you achieve a optimum scale.
Sure.
So I think there are a lot of margin tailwinds going forward, and it is a good problem to be in if margins are down because of higher growth.
Sandeep, I take all of your points. The thing is that a lot of these stocks have anyway rallied. I mean, this is the one pocket, one of the few pockets in the market that's really working. So the question is, for someone who's buying fresh now, give us your maybe top 2 large cap ideas and the top 2 mid cap ideas. I mean, L&T, you know, Infotech, for instance, has had a remarkable rally. So again, which of the stocks you'd pick?
So see, we continue to like, you know, Infosys and Tech Mahindra in a big way, and I also like TCS, but it is little expensive. But I would like to highlight one thing, that, you know, we should not stand alone see the outperformance of the stocks. Means they have given 30, 40, 50% return, but you see the earnings growth jump. You know, from TCS, almost 0 EPS growth in 18, it is 20% plus in 19. So, you know, we have to also look at the kind of jump in the earnings growth rates have happened, and stocks probably had not done that great comparatively in my view. So there is a lot of headroom to go up. I would continue with my top pick as Infosys and Tech Mahindra, because I think the margin levers are very high here, and the growth differential versus TCS will be not much. But yes, TCS at 1800, 1900 level will be a very good buy, and I would recommend at that time. But right now it is little expensive, so, you know, you have to undergo time correction maybe. On the mid cap, we don't like any stock. As I have mentioned multiple times, we are most bullish only on the large cap names, not on the mid cap.
Okay.
But the exception is the ER&D space. So in ER&D space, there are 2-3 players. One is L&T Technology Services, Persistent and Cyient. We like them. And one non-ER&D space, only one mid cap, which is there, is L&T Infotech, which we like. That we like because of very good leadership which is running the business.
Okay, we leave it at that. Sandeep, thanks a lot for joining us.